If you're a house flipper or wholesaler and you are not tracking this KPI, you are absolutely leaving money on the table. And it's not just tracking it, it's actually going back and analyzing it and using it to make decisions. And so I'm going to show you how to do all of that in this video. So let's get to it. But I guess before we get to it, I'm Max Emery, founder and CEO of Time Capital Bookkeeping, where we serve real estate investors. 100% of our clients are real estate investors. I'm a real estate investor myself, and we drive real estate investors to make better decisions through financial clarity. So let's get into it. What am I talking about? I am talking about ROAS, return on ad spend. And so what this is overall for your business, it's going to be the gross profit. So look on your profit and loss statement, that gross profit figure for any given financial period divided by your total ad spend, and then multiplied by 100%. And I'll show you how to pull that from this P&L. And then we're actually going to drill down into each individual advertising channel and get a ROAS for each individual channel. And then, key in on the ones that have the highest ROAS, and then talk about kind of some nuances. And because it's not always what it seems on the surface, we do need kind of context of what's happening with each of these channels. And yeah, we're just going to talk about all of that. I know it looks a little messy, but I'm going to show you, there are a lot of line items, but I'm going to show you exactly kind of where we're going to pull this. Okay. And so we have all of our income. And so total income here, and then we have all of our direct costs, cost of goods sold to achieve this income. Okay. So mostly flipping expenses, some wholesaling, COGS as well. And then we have our gross profit. Okay. And then we move on to expenses, and we have our advertising. So advertising is typically held kind of in the expense portion of the P&L. So we have total advertising, and then we have each individual channel. And then this looks like it got coded to just general advertising, if you will. And so we'll kind of exclude that, but here are the core channels. Okay. And so we're not going to exclude that from the overall ROAS, but we will exclude that from the channel specific ROAS calculations. And so general, just all advertising that this company does over the course of the year. And here's their gross profit. So it's going to be gross profit divided by this total advertising expense. And then that's going to give and then multiply by 100%. And then that is going to give us this 450%, total return on ad spend, which is good. It could definitely be better. But that is pretty good. And then for the channel, the ROAS of each channel, we're really just going to work within this section so that we don't have to keep scrolling up and down. And so just for you guys to know for the purposes of this video, so I pulled each of the total ad spend for each of the advertising channels directly from the P&L. So each of these numbers, I just pulled them down here. And then I have a gross profit per channel, which is not reflected in this general P&L, right? The way we would get this is there's kind of a slick way to do it, and then there's like a less slick way to do it. The less slick way is you have, your QuickBooks Online, per property financials, property level financials. So gross profit and, P&Ls for each individual deal that has been completed. And then we have some sort of, property CRM, we'll call it, or property, operations management software. And so that outside software that's outside of the financials, outside of the accounting, is going to show where each individual deal came from, like what channel it came through. So TV, SMS, SEO, whatever it is. And so the less slick way to do this is you would have to basically take one of these ads. So we'll just take a billboard. So if 5 deals came through billboard, you're going to go into QuickBooks or whatever accounting software, and you're going to pull P&Ls for the 5 deals that came through the billboard advertising channel. And you're going to get that total gross profit across those 5 deals. So you're going to add it up. It's going to come out to this. And then you're going to get, just from the general P&L, you're going to get the, total ad spend for the year or whatever the financial period is that the deals were sold. And then you're gonna, and then you have your 2 factors, right? And so you have the gross profit per channel, per the billboard channel. and then you have the total advertising spend on billboard. Okay. And so now you can take your gross profit from the billboard channel and divide it by the total ad spend on the billboard channel. And now you have your return on ad spend just through the billboard advertising channel. So hopefully that makes sense. So it's this number divided by this number multiplied by 100%. But if you're in a Google Sheet or Excel or something, you just designate these cells as percent cells, and it's going to automatically factor in the percentage side of this. Okay, and so you do that for each of these. So obviously that's a very manual way to do this. A more slick way to do this is, we use QuickBooks Online. And so you can do this with other software as well. They're just going to maybe work a little differently. But in QuickBooks Online, how we would do this, because we use the customer feature to track property addresses, okay? And that works very well for us and our clients. But we also have that additional class feature. We have the location feature. We used to have tags. QuickBooks doesn't do tags anymore. They got rid of that feature for whatever reason. But if we still had tags, we could use the tag, right? And so basically, each transaction for each property is being designated to, either the customer property address or the class property address, depending on what you prefer to use. We prefer customers since there's no limit on that, and we have high transaction clients. And so what we would do is we would create each of these ad channels as a class, since we're not using the class feature for anything. And this is QBO Plus and above, so QBO Plus or QBO Advanced. And we would create each of these as a class per how we do things. And then each transaction that's tied to a specific property, we're going to tag or we're going to class, what ad channel it came from. So if we're processing transactions for 123 Main Street and we know 123 Main Street came from SEO, then, we're applying the SEO class to every single transaction associated with 123 Main Street, in addition to applying the 123 Main Street customer. Okay. And so that's a more slick way to do this. And then we can just pull, we can pull up a P&L, we can display the columns by class. And now we have our gross profit. We have all the financials really, per ad channel for that given period of time. And so that is a much quicker and much slicker way to do this. But if the software you're using or whatever you're using to do your books, if you don't have those types of features and capabilities, then you can do this the less slick way, which is the more manual, more time consuming way. But you can still do it, and you should still be doing it because this information is super duper powerful. And so I'm just going to blow this up so we can see it a little more easily. And let's get this over here. Okay, you guys should be able to see that pretty good. And so, this is the overall ROAS. It's not nearly as useful as the per channel, right? Like it's useful, okay, if we have an industry benchmark of 300 to 800% ROAS is kind of what like a house flipping or wholesaling company should be going for, then great, we're within that range. We have a healthy ROAS. It is on the lower end of that range, and so that would cause me to want to look at each individual advertising channel and see what the ROAS is for those and see how we can optimize. And so that's really what we're going to start to go over now is let's look at each individual channel and let's start to use this KPI as a decision-making tool. And so getting into per channel. And so you can see here, I've ordered each of these, from lowest to high. And so you can see very clearly, we have two pretty big outliers here where it's like, whoa, that's a 15x return. That's an 11x return. So crazy numbers for ROAS. And so SEO, basically what I'm going to start to look at next is how valid are these numbers? Can these numbers be trusted? Maybe it was just kind of an outlier type of season, and it's not going to consistently produce at this rate. For SEO, a good bit of money was dumped. $43,000 over the course of 12 months was dumped into SEO, and it's got over a 15x return. And so, I would say that number can be reasonably trusted. It's a good amount of time. It's a good amount of money, for the size of this company. And so I would say that's a pretty good, we can trust that. What this tells me is, oh, wow, we need to spend a lot more dollars on SEO, whatever that looks like, right? It could be hiring a blog writer. You're pumping out 1 or 2 blogs a week that are SEO rich, tied to the website or, lead magnets and all that stuff to get more leads in, and whatever else in the SEO, hire an SEO expert and just go crazy. I think that would be a safe bet looking at these numbers. For DM, so direct mail, that's where they're actually like mailing letters to houses and then sourcing leads that way. Not a whole lot of money was spent on direct mail. I mean, this is a 12-month period. Only $5,000 was spent. That's a very low amount of money, especially for a business of this size. And direct mail is pretty expensive, to be honest. So that is a very low amount of money. That's a couple of campaigns maybe. And so, I don't know how easily we can trust this. I know where this specific client is located, and where they're located, direct mail does hit really good in that region of the country, in the Southeast. But for me, not enough total funds were spent on this channel for me to really trust this ROAS, especially over a 12-month period. And so I would want to 3 to 4x this and just see what happens to the ROAS. And if it continues to perform at this level, amazing. Like we're going to dump a lot of money towards direct mail then if it continues to produce at an 11x return. But I have a feeling this would go down, just giving the context of the gross amount of dollars spent over the course of 12 months on this specific channel. So going down to PPC, pay-per-click. And SEO is search engine optimization. I guess I should spell these out just in case. So pay-per-click, very healthy ROAS, and a good amount of money was spent, a good amount of money was made. And so I think this is a safe one to also pump some more dollars into. Obviously it's number 3 on the list. It's not number 1, so we're not gonna solely focus on it. But I think we could reasonably feel comfortable pumping a little more money into it. And so, and kind of where are we going to get the money from, right? Well, Billboard, that's a pretty poor performance. It is making more money than it cost, but not by much. And this is over a 12-month period. And, this company has multiple partners, and this ROAS just it's not nearly as good as, some of these others that we can spend more money and time on. I would honestly, if I was this client, I would X Billboard. I would get rid of it. So now we have, $75,000 back in our pocket that we can redeploy into some of these that have a much higher ROAS. Okay. And so, TV, this is an interesting one. Low ROAS. 3x return, that's like bare minimum what we want to go for. So on the lower end for sure. But looking at, this is the total gross profit of the entire company for all of 2025. And so this accounts for like a third of the entire gross profit for the whole year. And so we don't want to say, well, TV is not performing very well, we're just going to exit and, redeploy these funds, 100% of these funds, because, we doing that, we would chop off a third of the gross profit for, potentially for this next year. Right. And so we're not going to be that drastic with this. I would probably start to maybe just cut this in half, take away 150K or so, 175K out of this number, and, put it towards SEO, potentially, a little bit towards direct mail, just to maybe 4 or 5x this, just to do an experiment. And then I would put more towards pay-per-click, and I would put more towards Facebook. Because those are healthy amounts of money. Like this is, I think, a tested thing. So spent a good bit of money, made a good bit of money, solid returns. So these are, Facebook, pay-per-click, and SEO. I think we can trust those, and I think we can redeploy a lot of capital, into those channels with the primary being SEO. And so TV is an interesting one. On the surface, it's like, yeah, let's just exit, let's just X that out. But then you look at, whoa, that's the most gross profit out of any of these channels for the year. And so we can't, it's just context for each of these, right? It's not black and white. You have to think about the whole picture. And some people may disagree with what I'm saying, and that's perfectly fine, right? We'll each have kind of our own interpretation of this stuff. SMS, it's just middle of the pack. Not that much money was put into it. It did make, almost a 5x return. So solid ROAS, kind of middle of the pack ROAS. To me, it's, we could probably X this out and redeploy this 15K, into DM. That's probably what I would do here. I'd probably take this 15K and just move it directly to DM and just get rid of SMS. And then I would have Facebook, I'd have pay-per-click, I'd have SEO, I'd have my DM, cancel out billboard. I would have maybe 150K left to put towards TV ads because it doesn't produce that well. And then I would redeploy the rest across SEO, pay-per-click, Facebook. So that's what I would do with this to make a lot more money than is currently being made. And it's, this company makes a lot of money. So gross profit, and they have a very healthy, this is the net income figure for the year. And this is, after salaries and stuff are paid out. And so, healthy profits, successful wholesaling and house flipping company. But we can always optimize, right? So this is the importance of looking at this stuff. I would look at this stuff on a quarterly basis at a minimum. But if you set up your accounting structure appropriately, you can look at this stuff as often as you want, right? Because it's as easy as, clicking a few buttons and then, filing a few things into an Excel sheet or a Google sheet. It's very quick to get this stuff if your accounting structure is set up in a beneficial way that fits your company and like what you want to track. And you absolutely should be tracking ROAS as a house flipper and or wholesaler. So I'll leave it there. And this is the type of stuff too. If you're a bookkeeper watching this is the type of stuff that we go over in our Bookkeeping for REI school community. So just go to school, skool.com, type in bookkeeping in the search bar and the discovery, window that they have. And we're the first community up there. So Bookkeeping for REI is the name of the community. This is the type of stuff that we go over. This is the type of stuff that's in our courses. And if you are a real estate investor and you want to take advantage of stuff like this, Time Capital Bookkeeping, that's our bookkeeping firm. 100% of our clients are real estate investors. We will take care of you.